afternoon and welcome to today's Premium Account short form market update. The information is prepared for general information of traders and investors. The information does not take into consideration the specific needs, investment objectives or financial situation of any person. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today myself, Leon Hein, current Managing Director of Global Equity Management and the Investment Manager for the Investor Signals Unit Trust. I have over 15 years experience in the financial services industry and are a licensed securities advisor. The format for today's presentation, we do a quick review of the global macro outlook driving equity markets. We review last week's earnings result with a specific focus on Fox, Rio and Telstra, and we look at this week's results, which include Newcrest, Stockland, CBA, Computershare, CSL, Leighton's, AMP and Wes and Santos tomorrow and Friday. We look at our equity buy orders and derivative overlay that we've been implementing across the last week or so. And we conclude with the short-term Australian market outlook. The services we provide are up on screen there, and if you'd like to know more about those, please contact either myself or Christine, info@Investor Signals. Up on screen at the moment is a graph of the XJO, and if you'd watched last week's recording, I did a full review of the ASX Top 50 and spent a fair bit of time on the global macro outlook. So today's recording is designed to be a short form presentation, so it's more of a summary approach to what we're looking at in the market. And a quick review of the XJO. So as we approach earnings seasons, we're trading on a high multiple. We're seeing a lot of our stocks up at PEs anywhere from sort of 17 to 21 times earnings. That's somewhat a function of the low bond yields that we're seeing as interest rates come down in Australia, and obviously they're low globally. What we're seeing is money move into equities for dividend income, and as a result of that, what we're seeing is the dividends compressed down or the valuations of the stock goes up, and therefore the market's trading on a higher PE relative to historical levels, and it's probably going to stay that way until bond yields start to rise. So yes, on the surface the market looks expensive, and we think arguably the earnings results are not there to really carry the market too much higher at the moment. When you look around at global GDP, US GDP in the fourth quarter was tracking at around 1.7% annualized. We've seen Japan come back a little bit to an annualized rate of maybe just under 3%. The positives in the economy are that the Chinese economy, the export data there and the manufacturing data all looks to be stabilizing or improving. Europe seems to be turning around. We're seeing the early signs of better sentiment readings coming through from Germany. We're seeing better industrial production numbers for the Eurozone in general, and then we've obviously got this ongoing recovery in the US property market, which is leading to slightly better retail data, slightly better growth rates in general throughout the US. The area of question is we're seeing the US 10-year treasuries. They've moved from a yield of around 1.6% up to 2.7% at the moment. So the big question on a lot of investors' minds is when is the Federal Reserve going to start withdrawing the stimulus? We're probably more of the view that we think that central banks have a lot further to go to get the global GDP tracking up at around 3.5–4% opposed to where it sits at the moment at almost half that rate. So what that means for Australia is likewise our GDP here is tracking a little bit below trend. Inflation's fairly tame or below trend, therefore the RBA is able to lower rates and try to stimulate the economy. From an earnings standpoint, we're probably at best going to deliver about 6 to 8% EPS growth in 2014, and I think from a valuation standpoint what that means for us is the market is likely to stay within the range that we've forecast now for a number of months. We were buyers at 4,600. Up here we start to sell calls again and we start to cap a lot of stocks over the next 2 or 3 months. We've got stocks predominantly going ex-dividend throughout August and September, and so when you strip out that sort of 2%, 2.5% of dividends coming through over the next couple of months, we don't see that there's room for a lot of upside appreciation in equities over the next 8 to 10 weeks. But ultimately what we are looking for is more synchronized global growth as a result of central bank policy that kicks in around that November period, and we start to see an uptick in equities again into the early part of 2014. So on that basis, let's move to have a quick look at the stocks that have been reporting, and the first on the list was Fox, which reported last Wednesday. And just to summarise the information that came out here, so they a strong financial result. Revenues were up 7%, EBITDA was up 8%. From a forecast standpoint into 2014, we'd expect Fox to deliver probably very low single-digit earnings growth. From an earnings per share growth, and I think that'll be somewhat supported by an ongoing $4 billion buyback that the company's going to carry on with. So whilst we see it sort of pushing up to the top end of its valuation, this share buyback should support the price, and we're looking for it to start to consolidate up at these levels, and we see limited downside risk in Fox. The other name that reported last week was Rio, which obviously came in roughly in line with expectations. Iron ore prices are now up at 140 US a ton. If you go back, a number of months, there was a lot of doomsayers that were predicting that iron ore would go down to $80 or $90 a ton on average. So when you look at a lot of the analyst forecasts, they were modelling earnings growth on the assumption of iron ore tracking around 110, 120. So the likes of BHP, Rio, Fortescue are probably due for some type of earnings upgrade, given that spot iron ore prices, again, as I mentioned, are holding up at around 140 a ton. What that means for Rio, I think if you go out into 2014, I think the company can deliver 15% earnings growth. It's trading on a very low multiple, around 8 or 9 times earnings. I think there's scope for Rio to trade back up to, maybe 10 to 11 times earnings. With that earnings uptick, fair valuation for the stock's probably somewhere between $60 and $70. So I'd expect to see the stock sort of consolidate at or near these levels. It's gone ex-div today around 93 cents. Our preference again has been the exposure into BHP and Woodside, and I'll jump to those in a moment. But Rio's result essentially met market expectation, and if we have a look at the other result from last week, which was Telstra, so the key numbers here in Telstra was that total income or revenue was up around 3.3%, earnings before interest, tax, depreciation was up around 4.8%. If you strip out the extra income that came from the NBN payments, that growth was probably more around 1.5 to 2%. Financial 14 guidance for Telstra is single-digit growth income, probably somewhere in the order again of sort of that 4% as a target growth rate. With the stock now trading at sort of 5.5% dividend, and no confirmation that the dividend's going to be increasing from the current 28-cent annualised rate, I think the stock's reasonable value up at these levels. What we've been doing is selling the 520 covered call into December, and I'll just give you some specific numbers on that. We've been getting around 10 cents for that. So where we own the stock at or near these levels, and we've gone out and sold the 525 January, and we're getting around 10.5 cents for that. So on an annualised basis, it's kicking that cash flow in Telstra, up to from sort of around 5% up to around 10%, and allowing for a further sort of 5% capital growth in the stock from current levels. But we really, continue to form a view that it gets much tougher from Telstra to replicate the same type of advances in the price. We'd expect to see it move into more of a consolidation pattern up at these levels. And in this week, we go to the earnings results that have come out. So GPT, this is a stock that we have some exposure to in both our internal account and client accounts. At around this sort of 360, 370, the stock's fair value, tracking at about a 5.5% dividend yield. It goes ex-div 5 cents tomorrow. The company's earnings results, I think, arguably were a little bit uninspiring. The market was looking for maybe up to 7% earnings growth. The company's tracking at around 5% earnings growth. I suppose one of the highlights of the result was slightly lower debt costs and, in general, constrained spending or cost control was a bit of a highlight of the result. Property fundamentals are, in general experiencing some headwinds, but that's just a function of the slightly slower growth that we're seeing in the domestic economy at the moment. I think these property plays have largely gone through their price adjustment over the last few months, I start to see them as a bit more appealing. They do need to be complemented with a covered call to really justify holding them, as I do think, sort of in line with our view on the market, at best they sort of consolidate and move sideways here. But I think they're names that we look back on in 6 months' time and recognise that this sell-off actually presented a reasonable buying opportunity in some of these property trust plays. Also reporting was Newcrest Mining, and I've put some notes up here on the chart just so the key details of the result was revenue was down roughly 15% on the prior corresponding period. Earnings before interest and tax were down 36%, and the final dividend was cancelled, which had already been flagged. The positives is that I suppose just to focus on the main positive is, if we go back 18 months ago, the company was delivering around 2.5 million ounces of gold a year. Because of production issues, weather-related issues, plant-related issues, that production guidance had fallen down to 2 million ounces, which is, in percentage terms, is quite a significant fall-off in impact to revenues. What was pleasing with the result is that the company had guided for the production to be between 2 million ounces and 2.1. It did come in at the top end of that range, so they've delivered 2.11 million ounces of gold. Some of their development projects are on track and look to be ramping up. The capital expenditure is obviously coming down, which is a necessity. The negative is the gearing in the company as a result of the asset write-downs that they've had is increased from sort of that 15% up towards 30%. So there'll be a real focus on the company in the next, really 36 months to manage that gearing level, whether that requires a equity raising or a capital raising through the issue of new equity. But all this obviously just hinges upon where gold sits. Gold's up about 10% off its lows. So the positive for gold is that China's been a very aggressive buyer of it in July. And we would look, if we see a recovery in the global economy, look, there's two schools of thought. Ultimately, whether all the stimulus that central banks provide lead to inflation down the track, that'll be good for gold. If the strategy that the central banks are providing doesn't get traction, then and deflation continues to occur, what that means is central banks have to continue to print money, and this risk that the market's seeing at the moment that gold's down on the basis that this Federal Reserve's going to stop its asset purchasing program, again would be a good result for gold. So I think the bottom line for Newcrest is, in order to see an ongoing share price recovery, we need to see gold trade back up to around 14 to 1500 an ounce. It's up 10% off its lows. Hopefully we see that trend continue to improve. Stocklands, let's have a look there. Stockland's result again, along with GPT, a little uninspiring. So where we're looking for growth of around that sort of 8%, the outlook statement is that probably more around 5% growth. When we look at sort of our specific strategy here on Stocklands, we own it at lower levels. We generated about 2.5% cash flow between buying the stock and then selling the 370 covered call into the end of September. So that tracks at about 10% annualized cash flow out of Stocklands. If Stocklands finishes September under $3.70, then we'll take that opportunity to resell the call again into December. And when you combine that call premium plus the dividend payment in that next quarter, the cash flow kicks up to around 5% for that next quarter. So I think even if Stockland sort of bounces between this 350 to 370 range, the fact that we're generating in excess of 10% cash flow out of holding Stocklands, and I think that, arguably we're probably at the trough within, the earnings pattern for Stockland at the moment. CBA reported today, came in line with expectations, about 7 well, a little bit ahead, $7.8 billion. The market was a little bit disappointed that the payout ratio on the div is going to remain at around 75%. So that div is going to sit at $2, where some investors were looking for it around $2.12. But CBA essentially delivering in line with expectations. Our strategy here is we've sold the 72.50 covered call into September. We collected around $1.50 for that. So effectively allowing for the $2 dividend to come out from current levels puts the stock back down at around 71.50 post the div. We're sitting covered calls at 72.50, so hopefully we're sitting at roughly the right level there going into September. If we are forced to deliver the stock, we own it at lower levels, and effectively we're delivering an exit price there of around $74, and that's even after the dividend, so probably sitting at about the right level there. If the stock closes below our strike, what it's meaning is that we've added an extra $1.50 of income for approximately 60 days exposure there in CBA, so significantly boosting the cash flow from CBA. CSL's result came out today. I haven't had a chance to go through this in great detail. The market was looking for earnings growth around 22% and forward guidance for low double digits, so somewhere around 12 to 14% earnings growth. From a first look at the results, they've come in a little bit below, around 19% for 2013, and a slight downgrade to the outlook of around 11% earnings growth. What we need to look for is to see whether the company's made any further comments around extending their share buyback. But our core view here on CSL is that it's expensive from a PE standpoint, trading up at around 22, 23 times earnings. Leighton's result was another one that was out today. I haven't had a chance to go through this in great detail. When we look at sort of some of the key numbers the market was looking for, first half 13 results out today should have delivered something around $254 million, which is almost double the previous corresponding period. And a full year FY 13, we're looking for net profit after tax for around $530 million. I think maybe Leighton's could be a name that on a 12 to 24 month outlook, the picture really starts to improve, and again we look back in a year or two and recognise that Leighton's was pretty good value down at these levels. What else have we had report? So Computershare, so I'll just touch on this. Computershare, we've been pretty aggressive with the covered calls on this. The market was pretty bullish, looking for 10 to 15% earnings growth in 13, and confirmation that the company was looking for similar growth into 14. I think it's still a buy down here at around this 975. We've sold calls at around the 1050 level, and I really think that's the range over the next 6 months. Later in the week, or tomorrow, we have AMP reporting. As I've chatted about, flat earnings growth here. It's really a yield play, tracking at about 5.5%. We've got Wesfarmers reporting tomorrow. We're looking for about 10% earnings growth here in Wesfarmers. Again, from a PE standpoint, the stock's very expensive, up at around 20 times earnings, but tracking at around a 4.5–5% dividend yield. I expect Wes to still be well supported, as is the case with Woolworths. And then Santos finally on Friday, looking for their result. We're out of Santos after owning it at lower levels. We've delivered it at around this $14 price point. I would expect, until we see more certainty around increase in production numbers, I think arguably Santos is reasonably full value up at this level. Okay, so to conclude today's presentation, I'll just quickly sort of summarise some of the trades that we've been setting just over the course of the last week. So AGK, we've been buyers of it down here at around $14.50. We see full value back up at around $16, but at the margin, for new money coming in, we're happy to own it at this level, sell the $15 calls, collect the upcoming dividend, and we're getting about 30 cents for that call premium, which is generating in excess of 10% cash flow per annum. Amcor. Now, we've been waiting for a more significant pullback in Amcor, ideally to really move to a strong overweight position in Amcor. We'd like to be buyers of it down around $10, but I think as the company comes into this approaching demerger, history would suggest that the larger of the demerged entities goes on to be a strong performer, and I spoke about that last week, being the international component of Amcor. The Australian domestic component that'll be spun out will have a lower growth rate, of fully franked dividend, and probably a higher dividend payout ratio. The international component will look to sort of have that 10 to 15% earnings growth over the next number of years. So it's just a matter of, do we want to pay a slight premium to have exposure to Amcor ahead of that demerger? And to the extent that we are re-entering Amcor on some client accounts, we're selling sort of the $11 calls into November, which we're getting 33 cents, or alternatively we're pushing out a little bit further into the 11.50 Januaries, where again we're delivering the stock at a higher strike, 11.50, but collecting that same premium around 30 cents. What that's meaning is, combined with the upcoming dividend, again we're getting about a 10% cash flow out of Amcor and allowing for about 10% capital growth in the stock over the next anywhere from 3 to 5 months. BHP, so this strategy has paid off. We've been patient here with BHP. We've been waiting for the stock to rally. It's finally got up to our price target of around $36, $37, and we're selling the covered calls anywhere from sort of this $38 level through to $39.50. I really think that sort of captures the upside for BHP. Again, about 15% earnings growth in 2014. Stock trading about 10 times earnings. I think it's fair value. Iron ore settles at around $130 to $140 a tonne. The earnings upgrades will support a price consolidation at around that $38 level for BHP. We're getting around 70-80 cents for the 38.50s, and we're getting almost $1 for the 39.50s into that December period. So effectively we're exiting BHP somewhere around that $39 to $40 level after owning it at lower prices. Also Coca-Cola, so this is one I've been chatting about. Earnings growth have been downgraded by the company. We were looking for 5% earnings growth. The company's forecast flat earnings growth at about a 4.5% dividend yield. The stock's fair value. So for new money coming into the market, we're happy to be buyers of Coca-Cola here. We're capping the stock up at around $13.25. We're getting 30 cents for that. Plus we collect the upcoming dividend later this month. So again, delivering sort of around 10% cash flow out of Coca-Cola. Couple other quick names that we've been involved in. So NAB, owning at lower levels, selling the 32.50 covered calls into December. They go ex-dividend in November, around 95 cents. Origin, we've been moving back into Origin just in a minor allocation at or near these levels at around this sort of 11.75. The stock's cheap, pushing up towards a 5% dividend yield. Not looking for a lot of earnings growth in the next 6 months, so capping that upside at $12.50, and that delivers roughly a 20% annualized return for us in NAB. Toll, see limited downside risks here. The stock's readjusted. We're expecting fairly flat earnings results for Toll, but at again around a 5% dividend yield. The stock's well supported, so we're owning it here, selling the 5.50 covered calls. Woolworths, we've been buyers of Woolworths just across the last week or so. We picked it up at lower levels around this $32.50. We've sold the covered calls predominantly up at around the $34 level, and we're getting roughly an extra 60 cents for those. Again, increasing that cash flow from sort of 4.5-5% up to around 10% per annum, and we'll be happy to deliver the stock post the div if it does settle up at around that $34 price range. And some exposure to Wesfarmers we've been setting, and obviously Wes has performed well, so where we own it at lower levels and we're participating in this rally. And some of the stocks that have gone ex-div just over the course of the last week that we've had strategies on is Westfield Retail, so went ex-div roughly 9.5 cents, as did the the parent company here, Westfield, or the International Property Trust, went ex-div roughly 22 cents, maybe a fraction more. Sorry, just to confirm that number, 25 cents it's gone ex-div. And we own that, and we've participated in that dividend payout this week. All right, so thank you for listening in, and just to conclude with a quick look at the XJO again, and that short-term market summary. So our base case is that equities are starting to get a little bit expensive up at these levels. We've been reasonably aggressive with the covered call strategies to drive sort of that extra income as we approach the upcoming dividend period. And the names that we like continue to be sort of Brambles, Computershare, Amcor, Westfield on sort of that weaker Aussie dollar exposure and US earnings play. We've been participating in the recovery in the resource names. We have moderate exposure to the banking stocks, but we've gone out and sold the covered calls into December post the November dividend that's to come through for ANZ, NAB and Westpac. And then otherwise the likes of Stocklands we've been participating in, and collecting the dividends from some of these property trusts, the early payers in the property trust sector. And really the large exposures that we've built are really in those defensive names of sort of Coca-Cola, Wesfarmers and Woolworths of late. Thank you for listening in. I look forward to speaking again next week.